Today we are talking about subordinate financing, second mortgages, gap funders, and the like. Can you allow it? Can you track it? We're going to break it all down right now.
Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
First of all, I just want to clarify that we're not talking about doing the gap funding and doing the second mortgages. We're talking about our business model of being a first mortgage lender. Can we allow this stuff? Do we even care? Do we need to monitor it over time? So we're going to give you all the details now about how we do it.
Yeah, no doubt. So there's a few things to kind of keep in mind. We talked to a lot of members of the Mastermind group, and they're like, hey, do you allow second mortgages or seller financing or someone that's putting up gap funding, loans behind you? And there's a few answers to that. So our loan docs don't allow for it, right? Like we don't want someone to put a second behind us. We don't want there to be seller financing. Now, every once in a while, there's exceptions to the rule. We can talk about that here in a second. But in general, our loan docs prohibit it, and then they, in essence, be in default if they do it. But there's no real way to prevent it, right? Like, let's say somebody does a loan today for, let's say somebody buys a property for $200,000. They come to us, we give them a loan of like $150,000, and then they go get a second mortgage in like a week from now for like $25,000. Like, I can't prevent it from happening. Yeah, you can call the loan and they're in default, but what in essence happens in that case? Well, I have to pay me off. Oh, I can't pay you off. Okay, we'll go foreclose on you, right? Like that, in essence, is what ends up happening if that's the case. So we don't typically allow it, but again, we can't control it. So it makes it slightly challenging. So let's talk about some different scenarios and there are times that we do allow it, but in general, the reason why it's not a great idea to have a second mortgage behind you in general is, number one, you want the borrower to put up the cash themselves, right? Like if we're doing a loan, we can use that exact same example. If they're buying a 200, we'd probably be lower than a 150 loan amount, but let's just say that. Like if we're doing a loan of 150 and the expectation is the borrower is putting up the $50,000 of their own cash, that's their skin in the game. Like we want it to be their money. We don't want it to be somebody else. And then they have no skin in the deal. Borrowers that have a lot of skin in the deal or a lot of cash into the deal don't typically default or don't typically walk away from a project. Borrowers that take 100% financing out or have sweat equity and the deal starts falling apart, they walk away from projects. They default on a project. It's pretty easy to walk away from like sweat equity and stuff like that. It's hard to walk away from your own capital that you have because you want to get some of that money back if you need to. So if I do a loan for $150,000 and I'm expecting borrower Jim to bring $50,000 to the table, and he, in essence, someone else is lending him that money to put up, and borrower Jim starts defaulting, like, okay, I don't have any skin in the deal. I got nothing to lose. I'm just going to walk away, and it's everyone else's problem except mine. Again, collateral, we're in a good spot. I get that. And collateral is the most important thing in a deal. And I certainly get that. But having a vested interest and having a hard-earned cash and real money, real skin that the borrower's putting up is just stronger. It just is.
It is stronger. And we've seen these scenarios play out in a number of different ways over the years, because the reality is that residential real estate investors, they use subordinate financing all the time. Not all the time. It's common. It happens frequently. And sometimes the situation works out fine. And there's a couple ways it can go sideways. So let's break down some of that. So if a strong real estate investor who can document that they have a lot of cash in their account, so several 100,000, whatever it might be, in their business account, and they have that money and they just, for convenience, happen to use subordinate financing from a gap funder or a, second mortgage kind of person, that can be okay. And you might not even ever know about it, right? You might not even ever hear about it and the deal goes fine. Because in a lot of real estate groups, both online and offline groups, they encourage a lot of this. They encourage people getting into rehab deals by using a first mortgage lender like us, and then from this real estate investment group that they're in, getting subordinate financing from other people in that group who are looking to make a double-digit rate of return. Sometimes it works out fine, sometimes it doesn't. Sometimes these other people who are putting up money are savvy, and sometimes they're not. And this can work out in our benefit or not. Sometimes, unfortunately, these people get duped into putting up subordinate financing money, second mortgage money, or maybe even unsecured money to a real estate investor who's maybe not the strongest investor out there and can end up losing their money. And that's unfortunate when that happens. Sometimes that subordinate financing comes from a savvy private lender with deep pockets. And we've seen it in that situation where it could even work out to your benefit, where if we go to foreclose on a property and there's a second on it, they're going to get wiped out. They're going to lose their entire investment. So now we have another party that's has an interest in keeping this deal alive.
Yeah.
Protect their own money. Possibly we've sold notes to or sold our first note to a second investor before. We've had them keep a project afloat in order for a job to get done and sold for market value so they can get their money back. And we've seen that happen before. But unfortunately, oftentimes the people who end up doing the private lenders who are doing these like subordinate liens and stuff are typically not that savvy and don't have super deep pockets, and they can just get themselves in a bind. And again, like Jason started with, like there's very little we can do to prevent this. If somebody wants to, they own the property. If they want to put a lien behind our lien, like it's going to happen, right? Even if you were checking on it, you couldn't prevent it.
Yeah.
So yeah, I mean, just a number of different ways that this can play out, and all stuff to just really be aware of.
Well, it's not just be aware. You got to ask questions on stuff. And we asked for a bank statement or asset statement so we know where the money's coming from. There's a few ways that you can structure these. I'm going to talk about that here in a second, but it's important to understand it. And this isn't necessarily the topic of this episode, but I was thinking about this as you were talking. Too many lenders don't ask enough questions. They don't know enough about their transactions. And the reason that I know that is because I talk to a lot of them and I ask a few quick questions. They don't know the answers to them. They have to find out. So you got to, like, I'm not saying you're scripting that question up front of, hey, where's your money coming from? Or, hey, you're not taking a gap funding, are you? You're not doing a seller second. But, you know, be friendly with them on the front end to see if they ask those questions. And then if someone's putting a second mortgage against it, you should be able to see it and you should be able to kill the deal at the closing table if that's happens, right? Like if they're recording a second mortgage, first off, the title company should not be hiding that from you, although that does happen. But you should be able to see it on the settlement statement, and if they're getting title insurance, you see it on a title commitment as well when you're reviewing that during your underwriting process. But again, ask a lot of questions and see. Um, it's not always the end of the world. We're gonna, again, I know I keep saying we're getting to that, but we're going to here in a second. Why sometimes it could make sense. The other thing besides the skin, it's also the exit strategy. You don't want to prevent an exit strategy on some of these deals. Some of these borrowers in today's market, they're overpaying for properties. They're paying a high dollar. They're paying more than they should. There's a reason that they need a lot of cash to the table because they're just not paying a lot. So, or they're paying too much on these things. So be like, oh man, I don't really have 100 grand that I can put down. Can the seller hold a second? And sometimes it could make sense. The challenging part though is you don't want the extra, that you don't want them to have, 100%. Let's say somebody pays retail for a property, right? $200,000 retail. You give them 130 and then they get a seller to put up something at 70. There's no equity in this thing. Not only are they potentially not making money on this thing, but like they don't have a way to exit the deal, right? Let's say it's a rental property. Let's say it's in an area that has not really a good flip area, but a good cash flow rental property, and people can pay 100% market value and turn it into a good rental, and you still get a good rental rate on it. Let's say you're in an area like that. Well, and then you give them a 65%, based on as is value loan. They get a 35% loan from a gap funder or from another lender and do a second. There's no exit strategy. There's 100% leverage on it. How are they going to pay it off? They're going to have let's say they go get a DSCR loan or a bank loan, they're going to bring 20 or 30% to the table then. Might as well get them to do it on the front end. So that's one thing. Also, you got to go through the whole foreclosure process if the deal defaults. You can't do like a deed in lieu in that particular case.
True.
Not that we act on that all that often or do that, but they can't deed it to you. You'd have to foreclose that second person off. What Chris said is right. Every once in a while, you get lucky, and they ended up doing a seller, or not a seller, a second note from somebody without you even knowing. Maybe they went over construction, or maybe they needed money, or maybe they just want to recoup their own cash, whatever it was. Maybe they're trying to buy another deal and they know they have a lot of equity in this particular deal. So they get someone to give them a second. And we don't even know about it. Every once in a while, you get lucky. And when you go to default them, they have someone else who has a vested interest in this property because they're the second note holder. They don't want to get wiped out by this hard money lender. And, maybe they buy the note. Maybe they figure out ways to bring the loan current. So it's not always a bad thing. Go ahead real quick, and then I'll tell you two solutions that we do regularly that I think make sense.
Yeah, what you said there brought up within the past year. Yeah, both within the past year, both in Pennsylvania, we had two scenarios, two different borrowers, where we had a first mortgage doing our normal thing, purchase and rehab situation, and each of these borrowers, for some reason, after the fact, behind us, who knows what's going sideways in the real estate business, but they took a big blanket second. So it's funny how this happened very similarly. It occurred to me when you were talking. So like, property A with borrower A, we have a first mortgage, and this borrower owns a bunch of other properties, as many of them do. We've only financed one of them, and they get a private loan, and they tell a lender like, hey, you can collateralize, you're going to be a second, but you can collateralize this one and this one and this one and this one for whatever they needed the cash for, whatever was going sideways. And so this private lender ends up stuck behind us. And because they were over leveraged between the two loans, they couldn't exit the property for the as is value of the deal. Like if it didn't get done well, the construction job, or if it didn't get 100% complete, they couldn't do anything. And so like I've communicated with a private lender in this case, and they were just out of money. Like they gave this person too much money on too many properties. They weren't in a position to buy our note, and they took some hits. Like they got wiped out on the one we foreclosed on. And we were forced to go all the way through the foreclosure because of this. If that wasn't behind us, the borrower could have bailed. They could have sold as is. In one we sold and we had a pretty decent exit. And then the other one, we're actually under contract now, and it's going to close in a couple weeks. And it was a similar kind of scenario. And that one we're gonna have a nice looking exit. But yeah, just goes to show you that some real estate investors can get a little sideways. That's why they're getting these subordinate financing oftentimes, maybe just to limit their cash out of pocket. And it's not like a dangerous situation. I know that does happen. We see it, but sometimes it is because it's a sideways situation, and they might even be duping some private lender they know from the meetup to give them a blanket second on some stuff, putting them, kind of in harm's way too.
Yeah. All right. So let's talk about a few solutions that we've done in the past. Everyone, what will happen sometimes is a borrower will be like, let's say we do a loan of, let's say 200,000. So what would you say? So if we do a loan of 200,000, the average cash to close is probably, call it 80 grand with us. Probably give or
You
take.
think it's that high?
70, 80 grand.
100,000? Yeah, it might be.
I mean, it's typically between 30 and 40%, if not more, on some of these deals. Yeah. So call it 70 grand on a $200,000 loan amount that we're going to do. Borrower might be like, hey, listen, honestly, like, man, I want to work with you. I can't really do 70, blah, blah, blah. Well, how much can you do? I can do 50. And then maybe there's a way that the seller can hold back 20, right? That's still a reasonable amount, right? And then a situation like that works. What we don't want to happen is we do a loan of 200, the seller puts up 70, or a gap fund or a second mortgage lender puts up 70, and then the borrower has no skin in the deal. But like, if the borrower is willing to put up some of it or the majority of it, and then the rest of it's going to get bridged by another lender, no problem. That potentially makes sense, right? We do a loan of 200,000. The borrower brings 50,000 to the table, themselves, and then they find someone else to hold $20,000 or so and do it as a second. Everything's above board. Everything's okay with that. No problem. We're okay with that. I like that particular situation, and we'll put that in our scripting. Now, if it was flip flopped and the bar was like, oh, I could put up 20,000 and I can get the seller to put up 50,000, we probably wouldn't do that. I wouldn't do that. But if they're still bringing a substantial amount of money, and then there's a small gap and someone else brought that, no problem. So that's one option. The other option, and surprisingly this works, is getting the second mortgage holder to also sign on your debt as a guarantor. So in essence, they're involved in the project as well. And they have, it's their money, right? And I'll say that to somebody, be like, oh yeah, I have a second mortgage coming in. They're like my partner. They're going to put up all the money. No problem. If they're your partner, let's keep it fair. Let them sign and you sign. That's a fair way to do it, to be a partner. They can still be on the hook for that particular situation. So get creative on these things. The point
That was
is
a good creative one. I bet a lot of people hadn't thought about that.
Yeah. I mean, I think it's safe to say that let's hope everybody listening to this agrees that the more skin the borrower has in the deal and the more cash they put in the deal, the better the deal is. So just be creative on it. But there's other ways to structure some of these things, but I kind of like those kind of too. And we talk about that during, in our scripting as well, during our sales process.
All right, everyone. That's the pod for today. Hopefully these tips have put you in a position where your deals are more secure, less likely to lose even $1 of principal. That's our job here on the podcast and in the mastermind. If you haven't done so already, come visit us at hardmoneymastermind.com, and we'll see you here next time on the podcast.
Thank you for joining us on this Private Lenders Podcast episode. Please note that opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, financial, and accounting professionals. If you enjoyed this episode of the Private Lenders Podcast, we would appreciate it if you could spread the word. Make sure to check out hardmoneymastermind.com, the #1 community for all private and hard money lenders.